My name is John Mutua. I work at the Institute of Economic Affairs as a programs coordinator, and I also head the program on public finance management. So I'd like to welcome you to today's webinar. We are yet in another, we're in a budget season. And I believe many of you are aware, of course, that the current discussion or conversation that's going on is about the finance bill for 2026. And we are pleased as the IEA to share some of our insights on this bill this morning. The Institute of Economic Affairs is a think tank. It's a research organization that promotes debate and dialogue on public policy issues. We have 6 programs within the institute, and actually each of those programs, from PFM, Public Finance Management, Constitution, Law and Economy, Trade and Development, Futures and Foresight, Economic Regulations and Competition, and the 6th one is Popular Economics. All those 6 will be represented. So we will have program officers from each of those 6 programs taking us through sections of this finance bill. For some of you who may have interacted, so I actually went through the finance bill for 2026 as first before I get to the content. So it's basically the legislation or the instrument that the government uses in terms of raising additional revenue based on the proposals that are laid down. And so this bill has about 124 pages, and there are various schedules. And of course, the bill contains proposals for the key major tax heads. So we have income tax, VAT, value-added tax, excise duty, customs, and then of course it has also some amendments or proposed amendments around tax procedures, and then obviously on miscellaneous fees and levies. So those are the key areas. And the bill also has a couple of schedules or annexes, each explaining some details for the various tax heads. So in total, yes, there are about 124. It's 124 pages with about 52 sections. So it's quite big. Now, the National Treasury targets to raise 3.6 trillion for the financial year 2026-2027. And of course, this bill, the intention is to raise additional revenue that will contribute to the target. And the figures that we've seen, we haven't conducted any simulation within the IEA so far, but the figures that are mentioned is about 120 billion. But basically, even for the previous or the past finance bills, the projected or estimated revenue, additional revenue, is often between 8 to 10% of the overall target revenue, domestic revenue or ordinary revenue, if you like. And so it's the same. This one is actually even less than I think it's about less than 8%. So that's a bit of a background, and I think for now I will not get into the details. I think the thing to mention is one thing that we see for this finance bill in terms of the focus, it's actually more administrative. But even as the presentation go on, I'll let you to be the judge of that. Of course, Kenyans have been worried about, and obviously what the Treasury has responded is that there will be minimal introduction of any new taxes or raising of tax rates. And we'll see whether indeed that's the trend or trajectory that that the Finance Bill 2026 is following. And then, of course, we can also look at it from the perspective of the medium-term revenue strategy. What are some of the objectives, as well as the national tax policy, whether it's in line with some of the things that government, particularly Treasury, mentioned in terms of targets and objectives. So what we'll do, we will have, and I need to now count them, 1, 2, 3, 4, 5, 6. So 6 of my colleagues will share. So this is the outline. Of course, the income tax, VAT contribute the lion's share, are the major contributors to the overall revenue. And obviously, even the proposals are match that. So I think those first 2 or the first 3, they will take a bit more time. But the last 3 presentations will be, I guess, less than 10 minutes each. So we'll have the presentation go first, and then thereafter, obviously, open it up for any questions. As the presentation goes on, feel free to note whatever comments or questions that you may have. So we'll have a separate session, basically plenary, to ask questions or to make any comments. So I think, so without further ado, I would like to welcome, so the colleagues are Jacqueline Kagume, who will go first, then followed by Raphael on VAT, Raphael Moya, then Vivian Ochola for excise tax procedures will be, I think, Jairus. Then miscellaneous would be Steve Jairo, and then Emmanuel Chendo will conclude with the investment. And then, of course, Raphael will come back to just basically give a summary of the entire presentation or conclusion. Yeah. So, yes. So, without further ado, Jackie, karibu.
Right. Thank you, John, and good morning, everyone. We'll go through some of the amendments related to income tax, as John has stated. So in terms of the structure of the finance bill, the first amendments are those that are related to income taxes. So this fall from Section 2 of the bill to Section 24 of the bill. I think John has talked about the entire number of 52, so almost half of those relate to income tax. But I will not go through all of them, all the amendments, only some that we thought are interesting or concerning. So those are the ones that we will share this morning. So the first amendment, just beginning with Section 2 of the finance bill, which basically talks about the amendments related to definitions within the Income Tax Act. So the first one relates to the proposed expansion and definition of management or professional fees to include interchange fees and merchant service fees arising from card-based transactions. So that's just an expanded definition. And this amendment to us appears to be intended to bring those payments within the withholding tax framework following a Supreme Court decision. You must have had this discussed in the course of the analysis that we've been seeing online and on TV, the Supreme Court decision in the Barclays Bank of Kenya versus the Commissioner of Domestic Taxes case, where the court found that interchange fees did not constitute management or professional fees or royalties under the Income Tax Act. So we now have this amendment. If enacted, it would basically broaden the withholding tax obligations across banking, digital payments ecosystem. And in practical terms, this is likely to increase, in our view, the cost of digital and cashless transactions. And we know that once those costs are also ultimately likely to be passed to consumers. So as a CLE, this is particularly concerning for us. CLE is the program I work in, so the Law and Economy program at IEA. This is particularly concerning to us because it risks undermining the broader financial inclusion and digital formalization agenda. As digital transactions become more expensive, we see a real possibility that individuals and businesses may shift back towards cash-based transactions. Not that that is a bad thing, but these are harder to trace and tax. And so our position is that this clause should be withdrawn because in our view, it's likely to do the opposite of what it's intended. So it's likely to be to have adverse or negative consequences for revenue in the medium to long term because it may reduce the very digital transaction volumes that the government is seeking to formalize and expand. So that's the first amendment that we looked at. We go to the next. So still on definitions, we've seen an expanded definition of royalty. And so here the finance bill proposes to classify payments that are made for the use of digital platforms, payment networks, and payment processing systems as royalties for tax purposes. So our concern here is that internationally, if you look at best case practice, royalties are generally understood to refer to payments for the use of intellectual property such as patents, copyrights, or trademarks, and not payments for services. So, for example, using a payment or settlement system is essentially paying for a service being provided rather than paying to use an intellectual property right. So, from our perspective, this amendment or this proposal creates several problems or issues. So first, we see that it risks conflicting with Kenya's existing double taxation agreements and international tax standards, which could create legal uncertainty and disputes with our treaty partners. Then second, it could lead to obviously double taxation because some of these payments may already fall within other withholding tax categories, and particularly the management of professional fees. And then third, the proposal is also likely to increase the cost of doing business in the digital economy, particularly for payment providers and tech companies and so on. And so we feel that fundamentally there are a few policy problems with this proposal. And it's also important to note that this proposal continues a pattern that we have seen over the last three finance bills and subsequent finance acts, where the definition of royalty has been expanded, or we see this definition coming into every finance bill with some sort of scope for expansion, which is seemingly to try and expand revenue collection. But our concern is that this approach is problematic because of what it means for predictability and coherence of Kenya's tax policy framework. So having annually a different definition, an expanded view is problematic. So the frequent and almost reactive changes to core tax definitions create uncertainty for businesses that are dependent heavily on regulatory stability and long-term planning. So our proposal here is that the provision expanding this definition should be expunged from the bill, and we have what was there in the current year, in the previous year. Then we move to the next. So the third proposal, that amendment that we looked at, relates to the definitions of withdrawals and winnings in the gambling sector. So this finance bill proposes to make two changes at the same time. First, it replaces the current definition of withdrawals, and then it reintroduces a definition of winnings, specifically clarifying that winnings exclude the original stake or wager placed by players. And then the withholding tax would then apply to winnings rather than withdrawals. From our analysis, our perspective is that shifting this tax base from withdrawals may be logical and a clear approach. However, once the first shift is made, then the amended definition of withdrawals becomes unnecessary and redundant because the charging mechanism would already be on the winnings. So more broadly, our concern is that continued changes that we see to tax definitions, because this we've also seen in previous finance bills, and several changes have been done over the last couple of years related to the gambling sector, which seems to be lucrative for government to get easy revenue, which is fine, but there should also be some sort of predictability. So we've seen a constant legislative change creates uncertainty for businesses, for firms operating in the sector, and which in turn also makes long-term compliance and investment planning more difficult. We know that particularly with in gambling, where firms make significant investments in the systems, in compliance infrastructure and technology, policy predictability is extremely important. And so, I mean, I think it should, a stable and regulatory environment would be helpful for all players in that sector. So our proposal here is to adopt the new definition of winnings only, but remove the redundant amendment to withdrawals, and ideally provide some period of legislative stability before introducing further changes to these definitions. So that's the third amendment that we looked at. And then the next, so this one introduces a non-resident rental income tax under the proposed new section 6B. And here the bill basically proposes that where a non-resident person earns income from the use or occupation of property that is situated in Kenya, excuse me, that income will be subject to a final tax. And at the higher level, the intention appears to be to strengthen or broaden the taxation of rental income that is earned by non-residents from Kenyan property, which may be a legitimate policy objective. However, our concern is that it seems that this provision is drafted too broadly and lacks sufficient clarity. Specifically, if you look at the amendment, it refers generally to property situated in Kenya without clearly stating whether the tax is intended to apply only to residential rental income or to all forms of rental income, including commercial property income. And again, this creates uncertainty for taxpayers and for administration because the different interpretations could emerge regarding the scope of that tax. And this kind of ambiguity is also likely to increase likelihood of disputes with KRA or inconsistent application and compliance challenges. So our position in this instance is that there's need for clarification before enactment, and particularly on the specific categories of rental income intended to fall within the scope of this tax. So we move to the next. The other concerning amendment that we saw relates to the accelerated tax filing timelines. So this finance bill proposes to reduce the filing deadline for tax returns from 6 months after the end of the financial year to 4 months. And it also proposes that nil returns be filed within 1 month after the end of the year. So the issue here, from our perspective, the concern is that this timeline may not work efficiently for all categories. So for instance, it may work for individual taxpayers with simple income structures, so maybe the pay as you earn, but it's also likely to be very challenging for businesses and regulated entities where there are other things to think about. So for many companies, for instance, especially those that are subject to statutory audits or regulatory reporting requirements from other institutions, 4 months may not be enough to complete their audits and obtain the approvals, and just it's not sufficient time to reconcile tax positions accurately. So we are seeing a situation where there's likely to be rushed or error-prone filings. So, and this makes it difficult even for KRA, so which may, it's likely to increase disputes with KRA or repeated or amended returns, which is a problem for compliance, and the administrative costs for both the taxpayer and the government will be higher. So the burden is also likely to fall more on smaller firms, or disproportionately on SMEs, which lack some sort of sophisticated compliance systems that may be available to other larger firms. So we think that this here, the existing proposal should be retained, retain the current 6-month timeline. If it must change, a shorter period could apply for individuals, but I think what should happen is the current existing framework should be retained. Then similarly, the 1-month nil return requirement should apply only to entities that have been dormant, say, for a full year. Yeah, so that's the proposal here. And then we move to the next one. And so here these are an amendment related to dividend withholding tax in the EAC under the 3rd schedule, paragraph 3D. So the next, it's basically relates to removal of currently we have a preferential 5% withholding tax rate that applies to dividends paid to residents of the EAC partner states. So the amendment proposes to remove it. We are saying that at the moment, this lower rate is helpful or serves an important regional integration purpose, because it helps to facilitate investment and movement of capital within the EAC region. And so removing it would increase, obviously, the withholding tax rate to the general non-resident rate, making cross-border investment within the region a bit more expensive. And this obviously has both legal and economic concerns. On the legal side, we see that the amendment is inconsistent, or appears to be inconsistent with the EAC Treaty and the Common Market Protocol, both of which commits partner states to promote the free movement of capital within the region. And economically, the amendment risks discouraging intra-EAC investment, as I've already said, at a time when our regional trade and the capital integration remain key policy objectives. So we know that investors particularly are often sensitive to those differences in withholding tax rates. And so increasing that burden on regional investments could reduce the attractiveness of Kenya as a hub. So I think our position here is that the preferential 5% rate should be retained. And then as I move towards concluding, the last it relates to indirect transfers of shares that derive value from Kenya. And so here, the finance bill proposes to extend capital gains tax so that Kenya can tax gains that are made by non-residents when they dispose of their shares offshore. So where those shares derive value from assets located in Kenya, or where the transactions result in a change in ownership of a Kenyan company. And here we are seeing that at the broader level, this reflects an international trend that seems to be aimed at preventing tax avoidance through the offshore holding structures. Or in other words, companies should not avoid Kenyan tax simply by selling shares outside Kenya when the underlying value is actually derived from Kenyan assets. However, this proposal, as it is currently drafted, also is a bit broad and lacks some important safeguards. And our first concern is that the bill does not provide a materiality threshold, which means that the provision could potentially apply even where the assets form a very small portion of the overall transaction value or sort of insignificant portion. And if we look at best practice, what happens in other countries, India, SA, they apply a threshold, commonly 50%, before such gains become taxable. Then our other concern, excuse me, is the absence of a formula, an apportionment formula. So as currently drafted, Kenya could potentially seek to tax the entire gain from a transaction, even where only a very small percentage is actually attributable to Kenyan assets. So the risks here are overtaxation, double taxation disputes, increased uncertainty for cross-border investors, and mergers and acquisitions involving Kenyan businesses. So our position here is to amend it before passage by introducing those safeguards, either like a 50% materiality threshold and a clear apportionment formula, limiting the Kenya's taxing rights to only the portion of gains that is attributable to Kenyan-based assets. So I'll end at that. There were other amendments. We will share the detailed analysis.
I'll be taking you through the VAT section on the finance bill. And I'll start off by just sharing a quick fact about VAT. And basically, the definition of VAT is that it's a consumption tax, which is charged on goods and services, particularly by firms. And this is usually taken as the final, it is paid, of course, it is paid by the final consumer. Number two is that in terms of firms or in terms of business, is that firms are able to claim back VAT for their own purchases. And number three is that, so the section on VAT have got a number of amendments, and the first amendment is on the interpretation section, where when you talk about the interpretation is the definition of the keywords in the VAT Act. And what the bill proposes is that we need to amend section 2, which talks about assessment, talks about information technology, talks about computer technology. And then what we are proposing is that this is acceptable because most of the clarity about the definitions of these terms are contained in the Tax Procedure Act, and therefore we think deleting those words will provide more clarity in terms of in the VAT Act. And then number 2 was on taxable value over supply, and the amendment is contained in section 13, where it talks about higher purchase of goods and supply, which actually include credit related with to financial charges under a registered agreement. And we are saying this is an acceptable proposal because it reduces the distortion from the informal and non-compliance operators. And this, we are saying that it will be able to support revenue mobilization and we know very well there are quite a number of persistent, particularly VAT gaps and the pressure on revenue collection by the government. The third amendment, which is contained in the finance bill, is on credit for input tax and output tax. And the bill proposes that we need to insert a section by way of doing an adjustment of input tax, where the supplies of goods and services to the farm will now become exempt. And we are saying that this is an acceptable proposal because it will be able to improve VAT fairness by linking actually input deduction to the actual use, and it will be able now to preventing claims on exempt supplies and reducing actually revenue lost by the government. The other aspect is, of course, maintaining the question of the core principle of VAT on neutrality, where we know VAT is not supposed to be a cost to a farm. It's supposed to be an offset, where you offset output tax from the input tax, and therefore it should maintain that particular principle. The other amendment is contained on refunds of tax on bad debts, And the issue of tax refunds has been with us for quite some years, and amendments have always been there. And what we are saying is that what the finance bill is proposing is that we are supposed to replace 2 years with 3 years in terms of claims. And our proposal is that we are supposed to reject this proposal in totality, because we cannot continue extending bad debts on VAT refunds, actually extending by an extra year. And we know what it entails when we are talking about recoveries of money that has been on refunds. And we are saying this we worsen the cash flow of farms and harms, particularly the small and small and medium enterprises. The other aspect is on the amendment is on tax invoice. And the amendment is contained in section 42, where it talks about removing quote unquote registered person and requiring invoices showing tax to be issued only for genuine taxable supplies. And that's an acceptable again a proposal from the National Treasury, because what you will do is that genuine supplies will reduce issues to do with fraud, improve actually efficiency, and of course protect. It will be able now to protect our revenues. The other aspect is on tax avoidance schemes, and I mentioned that when we're talking about the tax avoidance schemes, these are schemes which make they make use of the loopholes that exist in the taxing system, so that they can be able to do fraud. And this section is being repealed through section 66 on tax avoidance schemes, and we are saying that we need to reject this proposal in totality. Why? Because we removing anti-avoidance weakens enforcement, and of course it will affect the issue of it will erode revenue collection and burden compliance to taxpayers. Now, this is the section that it talks about. It is the section on quite a range of products that are either given exemption, they are either zero rated, or they have got us they are sold at the standard rate. And when you're talking about exemption and zero rating, we are saying that products are sold at 0%. But when it comes to exemption, is that you cannot be able to claim input VAT when you are filing your return. But with zero rating, you are able to claim. You're actually able to claim this rate, and therefore it's an area that needs quite a number of interrogation. And whenever one need to make an argument, you need to look at it in terms of whether you are making an argument in terms of business wise or economic benefit. And therefore, the first aspect that has been given an exemption is on human blood, animal blood prepared using diagnostic, and the tariff number, you can see the tariff number, and they are risers. And the proposal is that previously these items were the blood and was at 16%, and this time it is being given an exemption. And our proposal is that we need to accept this proposal, because we deem it right that it will generate positive externalities, particularly in the health sector. Number 2 is on taxable goods for aid projects, and this exclude fuels, lubricants, and spares, particularly spares. The spares are the one which has been given an exemption, and the status is that the proposal is to maintain the exemption status, and we are saying that this is a justified proposal, because it will lower the project's operational cost, and ensure efficiency in the aid-funded projects. Let's go to the next slide. The other item is on taxable goods for tourism, parks of 50 acres or more. And this one have to be approved by the cabinet secretary. But what we are saying is that we have seen this proposal even in the two previous finance bill. And previously it was actually exempt. Now they are saying it is 16%. And we are saying this is not a good, it is not a good a good proposal, because we need to maintain exemption and expand tax advantage without arbitrarily actually discriminating a 50% requirement. That's an issue that we have consistently mentioned. The other proposal is a taxable taxation is a exemption. Is a 16% provision that is provided for direction funding campuses for airplanes, appliances for aircrafts. And what we are saying is that when you apply the 16%, of course, the intention of the government is to expand the tax base, and improve actually the whole aspect of neutrality. But this increase may increase actually operational cost and the airfare. So that's our argument. The other amendment is on spare part again, for spare part imported by operators or maintenance of businesses upon Civil Aviation Authority, again upon official recommendations. And this one again moves from exemption to exemption. And our argument is that the provision of exemption is actually enabling safer upgrades and compliance, and therefore we have an improved aviation reliability. The other aspect is on input of raw materials purchased or imported for pharmaceuticals, and upon the recommendation by the health secretary. And what we are saying is that previously it was 0%, and therefore this time it is being exempted. We are saying we need to expurge this cross, because exemption actually will block input recovery cost, and therefore the prices of these products, pharmaceutical products, might increase, and therefore the question of affordability becomes an issue. Let's move to the next one, please. Yes, this is I did this so that we can have a quick run of quite a number of items that has been provided, and the other item that is provided is the cellular network telephones, and the proposed stage is exemption. And what it means is that when it blocks input VAT recovery, and therefore what it means is that we are going to have increase in prices for the cellular network telephones. And then and this one has been familiar, the second hard clothing. This is something that has been in the public domain. The proposal is to have a 16% on VAT for the Metuba clothes. Therefore, we need to remove this. And why we are saying this is that we need to protect the low income household from higher costs. The other one is on PPP, infrastructure goods, where the proposal is on exemption of and we are proposing that we need to retain the 16% because it preserves the input recovery and lowers the project cost. The other aspect is on agriculture, where the sugarcane transportation has been exempted. And previously it was at 0%. And what we are saying is that we need to support our value chain efficiency and avoid increasing, because definitely when we do the exemption, farmers will not be able to claim the input VAT, and therefore the prices of the sugarcane of the products will have to go up. The other aspect is on locally assembled funds. Again, the bill proposes exemption, and we are saying that we need to retain the zero rating of the locally assembled funds. Why? Because this one will prevent cascading of taxes, and actually it will be in support of our local industries. The other aspect is on electric buses, where again it provides exemption, and previously it was zero rated. And perhaps the reason why they are doing this again is to support clean energy and affordability. The other one is on exemption on animal foods. Previously, it was zero rating. This time around, they are providing they are providing an exemption, and we know very well that farmers will not be able now to claim the input VAT, and therefore the products, the production cost might go high, raising the prices, and therefore we are suggesting it is not actually a good move. Yeah. So John, that is it from my end.
Okay, thanks, Raphael. Yeah, so let's have to move along. Yeah, Vivian, karibu.
I'll be presenting the part of excise tax. So before I get into the amendments, let me first just review what is excise tax and why are they imposed. So the first reason, the definition is that excise tax is a tax imposed on specific goods and services. So it is not all goods, it's on specific goods. Then it is usually applied on products that are considered either harmful or luxurious products. Then, and we have examples. Some common examples where excise tax applies are on alcohol, tobacco, fuel, sugary drinks, and even baking. Now, what are some of the reasons why governments impose excise tax? Number one is to raise revenue. That is the main purpose of taxes. Then also to discourage harmful consumption and to address negative externalities such as pollution and health costs. Then another thing is on to influence the consumer behavior. So with this background, because we are going to analyze this section based on why excise tax and also the principle of taxation to understand whether the amendments are going to be adopted or not. So the first amendment is under section 2 of the Excise Duty Act. So in this section, it states that goods originating from EAC, that is East Africa Community, partner state, and meeting the EAC rules of origin shall not be treated as imports for excise duty purposes. So this implies that goods that are originating from EAC shall be treated as locally produced. So the same rate that applies locally will be applied to goods that are originating from EAC. They shall not be treated as imports. So that does not mean that they'll be free, but it implies that the same rate that applies locally is the same rate that will be applied to those goods that originate from EAC. So this is a good move. We think this is a good move, and because this is a positive step towards deepening East Africa regional integration, so it will help reduce trade barriers. Now, goods from Uganda, from Tanzania, will be treated as locally produced. So this is a good move, and it should be adopted. The next slide. Now, Section 37 of the excise duty on cellular phones. So it replaces definition and also imposes tax. So it replaces imported cellular phones with broader definition of telephones for cellular and wireless networks, and also imposes a 25% excise duty, which is a raise. Initially, it was 10%. So the first thing we need to ask ourselves here, we'll remember we are saying that the purpose of excise taxes is for negative externalities, for harmful consumption. We need to ask ourselves whether using a phone is harmful or whether it has a negative externality for it to be applied, or for excise duty to be applied to the use of cellular phone. And another thing that I didn't capture, it was a phone activation. So what does it mean? How is it going to apply? It also, when you look at the principles of taxation, it is also a complicated one. Upon activation, what does that mean? How are they going to apply that? So it is not clear, it is uncertain, and therefore it is not a good move. And if you look at countries that have imported tax on usage of phone calls and SMSs, 25% is very high. Some countries like Tanzania has about 17%, others less than 10%. Then, so these are not a good move. And another thing, it failed the simplicity test, and it is also relatively high. Then under section 37, clause A, 6, we're able to see that the bill or the amendment, the finance bill proposes to raise ciders, carrots, and cigarettes containing tobaccos and substance. So they are raising it from 16,260 Kenya shillings per kg to 18. So these are significant raise of close to 10%. So if you look at this, the justification is okay. It's good for both fiscal and that is for revenue collection and also for correcting externality for public health as well. But I know in Kenya we have had cases of smuggling. So if it is raised to that amount, this proposal needs to be considered because it will lead to increased smuggling. So if it was at 16% and there were already 16,000 and there were already cases of smuggling, so when it is raised now to 18,000 per kg, so it is likely to increase more, to increase cases of smuggling. So there'll be more cigarettes coming into the country, not following the channel. So they'll be ending up losing the revenue instead of earning more by raising it. Then we have a section, that is section 37, still under section 37, but now clause at A 34. So it talks about 5% of exercisable value of coal. So coal has negative externality. It leads to pollution of the environment. Therefore, applying excise duty or excise tax is justifiable. But now this move is not clear because it just says that 5% of the exercisable value of coal. So our proposal is this will be based on the content of the emission. We know coal is used majorly in Kenya by the cement industry. So when this tax is being applied, it should be clear that it is applied. It should be applied based on the content of emission, based on the effect that using coal have, not basically generally of the 5% of the exercisable value of coal. So this move should be made clear or based on the content of emission or the intensity of the emission that coal has on the environment. Then we have this last one on the maintain on the excise duty of the alcohol. This is under now section 36 and clause 5, clause 4. So it says that it maintains excise duty at 22.50 per centiliter of pure alcohol on beverages with alcohol strength not exceeding 6%, with no preferential treatment for licensed small independent producers. So to explain this more, so initially what was happening is small scale producers were having a different excise duty of 10 shillings per centiliter of pure alcohol. So they were having a less amount, but now, irrespective of whether it is a large producer or a large brewery or a small brewery, they will all pay an excise duty of 22 Kenya shillings per centiliter. So this is a good move because the first reason is there's uniform taxation across all producers. But now the problem comes with the small scale producers or the licensed small independent producers. Initially, they were paying a tax of 10 shillings per centiliter, but now it has risen to 22. That is close to 125%, which is very high. So that is very high for them. Then now, so the proposal is that the rate is very high and it can encourage illicit alcohol consumption, especially in the small scale, because now they are paying 125% more than they were paying. So maybe if this can be reconsidered and maybe reduced to a small amount or maybe 12.50 rather than that high amount of 22%, because the small scale producers will be really affected. Though it is a good move because it ensures uniformity and equity and also fairness within both producers, but it is relatively high to the small scale producers who are paying 10 shillings and now it has risen to 22.50. Now, conclusion. So some of the amendments and even the definitions of terms will be found in the main document. So those were the major areas that we had concern in the excise duty. Now, for the conclusion, we have now excise taxes are very important when it comes to raising revenue, that is in the fiscal side, and even for policy tools. So, and we have seen in those amendments, some are supported with addressing, like the first one on the EAC and also public health, the one on coal and also the one on alcohol. Then others tend to increase the cost. There's complexity, like the one on cellular phone is a bit complex. Then when the taxes are too high, it also ends up encouraging illicit trade. Then lastly, there should be a consideration between policy balance, between revenue fairness and affordability. So policy balance is necessary. So it should consider revenue, in as much as revenue collection is important, fairness is also important, and affordability as well. So that is all about the excise duty. Thank you.
Steve Jairo, karibu.
Asante sana. So I'll take us through the few amendments we highlighted within the Tax Procedures Act. So the first was actual amendment to Section 3, which deletes certificate of origin and inserts virtual assets. Now, the amendment actually deletes in entirety the word certificate of origin and replaces it with virtual asset. But these two instruments are actually different because certificate of origin, what it does is that it satisfies that goods in a particular shipment, all of them or some of them are produced or manufactured in a particular country. But the replacement virtual asset is an instrument which represents value that can be digitally traded and can be transferred as a payment for a particular product. So in our view, replacing COO with VA, our proposal is that this should be done concurrently, not a one-off, because you can introduce the virtual assets while the certificate of origin is still in place, but that transition can take time. So our proposal is that we introduce virtual assets while the certificate of origin is still in existence, but then we provide a timeline for that transition to a full virtual asset within a specified timeline. So that's one of the key amendments that were proposed within the tax procedures. And then the second one, which was also important, was this one that removes tax exemption on imports. It deletes the 2-year exemption on steel imports. Specifically, the items were imported steel billets and imported wire rods. And these are more important in the construction industry. And this is one of the areas that the government today is actually keen on. If you look at it from the aspect of affordable housing. So this amendment removes the 2-year exemption for this particular product, and this product is used for construction purposes. So it will allow for cheaper imports of these particular items. And we are saying that whereas we want actually to enhance the building of affordable houses in the country, these cheap imports could hurt local producers. And that has a ripple effect in terms of job losses. And there's also the need to balance, of course, that with the long-term goal of ensuring we have those houses for our population. So the underlying issue with this is that this proposal needs to be considered so that we also allow our industries within to thrive. And third and last proposal within the Tax Procedures Act that we saw was as well important for us was on the agreement for automatic exchange of information with other countries. And this was more specifically on transactions relating to virtual assets. And we thought that compliance with this particular law will not only benefit organizations, but also has some positive externalities. So our comment that we need to ensure there's compliance with the Data Protection Act in its entirety, especially in the information exchange across borders. So this is a positive proposal because we are thinking it could also help. This information could help in the tracking of illicit financial flows and the recovery of those finances thereof. That's it for tax procedures. Thank you.
Okay, thanks, Steve. Moving on to Jairus, will take us through the miscellaneous fees and levies. Proposals on miscellaneous fees and levies. Karibu.
Okay, thanks, John. And now I look into the amendments proposed, and what we also propose for the miscellaneous fees. That's some background. This act was published in 2016, so it came in September that year, and it's about 10 years. During the time, we've had around 18 amendments. This now being till the 19th in a period of 10 years. That's an average of about 2 amendments twice in a financial year. And it imposes around 7 levies, 6 actually, about 7 levies and fees. That includes the export levy, which I'll talk about, the import declaration fee, the export and investment promotion levy, and others, which are. So, Finance Bill 2026 proposes about 5 amendments to this law, but of interest is the one on Section 55, which is to exempt imported telephones for cellular networks and other wireless networks from the import declaration fee and the railway development levy. While this is a good move, which actually would contribute to lowering the costs of imported telephones, and remember that Kenya is not a producer or manufacturer of telephones and therefore rely on importation, that would lower those costs, and therefore we support the move. But if you remember the arguments presented by in the sections of VAT and excise duty, realize that excise duty is actually being increased from 10 to 25 on the same items, which therefore is undoing the reduction that has been done here. Just for context, the IDF, the import declaration fee is 2.5% of the customs value, and the railway development is 4.2%, which adds to 4.5. So, yeah, we are getting an exemption here of 4.5%, and then on the other side, you're getting an increase of another 15%, which just actually cancels the reduction that we've gotten here. Now, the next amendment is is not covered here. Actually, what was important is what we've covered, but we are proposing some 3 crucial amendments because we think actually what is missing in these proposals is more important. So Section 5 of the Act, which introduces the export levy, and the export levy is charged on Kenya's exports, some specific goods on which are in Schedule, I think, 2. Now, the problem here is that export levy raises prices of Kenyan goods and therefore reduces their competitiveness in those foreign or international markets. And therefore, actually, that cuts on our market, and therefore it discourages trade growth and market expansion, especially for goods that we produce in this country. And I think it doesn't make good sense to chase revenue at the extent of hurting our market and our production and market. So strong recommendation is that we need to repeal Section 5 of the Act and therefore do away with the export levy, especially because it's just on a few goods. The other, and actually, if you read that section keenly, you realize it's just about something to discourage the export of those goods. But if we are trying to copy what Americans are doing with semiconductors and some rare minerals, I think those goods that are being levied at this imposed on this levy are not that sensitive to key areas where we need to cut the export. So yeah, we're also recommending repealing Section 7A, which actually is just something that was introduced a few months ago. That's the export and investment promotion levy. Interestingly, if you read through the act, it's about just before I finish on that 7A. So it increases costs of imported goods, and the clear goal here is protectionism, which we have argued several times that it's not good, and it distorts the markets. And one of the goods which are also goods used in construction, restricting their importation by levying excessively high rates of export and investment promotion levy is just a clear way of giving them creating a monopoly, which therefore hurts the final consumers of those goods. Next. Our other new proposal here which actually is very important, is on Section 7 to reduce, which we are proposing an amendment to reduce the import declaration fee, which is at 2.5% of the customs value, and our recommendation is that this needs to be cut to 1%. As my colleagues have already explained, we have a lot of levies, just other taxes on imported goods. And I think additional taxes on these imported goods is just overtaxation. And therefore, we still think that lowering these import declaration fees is good, because it's the higher the rates, then that is transferred to the final prices of goods, and therefore hurts the consumer welfare. Next, in the next slide, we are comparing the regional, we are comparing the import declaration fees, the rates, with our neighbors. So Kenya is at 2.5, that's of the customs value. Rwanda is between 1 and 1.5. Uganda is 0.75%, and Tanzania is 0.3%. If just look at those numbers, you already see that Kenya is an outlier, close to 8 times what we see in Tanzania, and close to 3 times what's charged, actually more than 3 times the rates used in Uganda. And therefore, Kenya as a market for imported goods is not actually very competitive, and therefore, I think it will be even more preferred to import through other countries than through Kenya. And actually, we think that while we're chasing revenues through these, lowering import declaration fees will be in the interest of Kenya and Kenyans, because of competitiveness and the prices on the final goods, which actually will be good for the consumer welfare. That's it from the import declaration fee and Levies Act. Thank you.
Thanks, Jairus. So we go now to the final speaker, Emmanuel, on issues of investments and trade.
Thank you. So what in general, we can see that the finance bill, which again is about raising is about how do we legislate how the manner in which the government is going to raise money in the coming financial cycle. And the second thing, which I think one of my colleagues had mentioned, which is that a country that is changing its finance bill all the time is not it's not a good sign. It's not a positive sign in any sense. What it actually means is, for whatever underlying reasons, the government is finding it necessary to change the laws about how it's going to collect money in the coming year, maybe how much it's going to collect, who it's going to collect from, the weight, how much it's going to demand from all the myriad of actors and the activities from which it's going to collect tax. That's not a good thing for many reasons, and especially also for investment. Domestically, as a business person, you are working in an uncertain environment, and the same is also true for the foreign investor. So we can see that the government is in a narrow fiscal space, and its responses are all over the bill. We can also see that Kenya is trying to declare fiscal sovereignty. And what I mean by this is that they want to claw back every cent of revenue that they believe is leaving the borders without being taxed. And they want to make sure that at the same time, there's local industry protections as have been a feature. Now, some of this hasn't necessarily appeared in the finance bill, but you've seen the posturing in the weeks leading up to the launch or the release of the finance bill. So when you get declarations like, say, from the CS of Agriculture about how much they're going to support at the agricultural sector, when you get reports about, so specifically saying how they're going to reduce the cost of inputs for agriculture, how they're going to make it cheaper for them to export, what kind of incentives they want to provide. A lot of this hasn't necessarily appeared in the finance bill, but still the posture is declare fiscal sovereignty and protect local industry. Now, what actually has happened in terms of foreign investments is this represents a step backwards for regional integration. It's a step backwards for foreign investment, and it's a step backwards for the domestic business. Why? Because for regional integration, EAC preferential treatment is being eroded in a way that's risking trade disputes. So what we'll see is that this erosion isn't coming with lowered taxes for say for example, are we trading preferential treatment of the EAC for in order to help consumers with the burden of the cost of living? Not necessarily. Are we reducing preferential treatment so that we can help so that we can move towards more trade liberalization? Maybe. No, this doesn't seem to be happening with this finance bill either. But are we doing this in such a way that we might provoke more trade disputes? Yes. In terms of foreign investment, so we're raising the cost for some while offering deep incentives for others. So if you are in the domain of you've built up a business and then you want to plan an exit, the government is not so happy about exits that they think were executed without the proper taxes being paid. So taxes, they want to close loops in terms of tax avoidance. Then finally, a step backwards for domestic business, because protecting local manufacturers, but maybe raising input costs, and we'll see how. Next slide, please. Previous. So, previous. Slowly. Yes. So, Section 36A, to amend the first schedule of the Excise Duty Act by deleting the words, and essentially the effect here is to remove some of those protections or preferential protections that EAC member states were enjoying. So the goods from the EAC will have the same excise duty rates imports from the rest of the world. This would not make you very happy if you are an exporter within the EAC exporting to Kenya. And we take the example of a glass manufacturer. I think its name is Kioo, and they were actually so they exported almost 50% of the glass products that are consumed in Kenya. And they claimed that given their projections for the coming fiscal year in terms of their exports that they plan to make to Kenya, that this new regime would impose a cost, the grand total cost to the industry, to those who are importing glass, of about $22 million. So not very happy campers on that side. In addition, this particular case had already had a previous episode to it, where the same company, facing very similar threats in terms of raising taxes, raising the costs of exporting to Kenya, actually took Kenya to the East African Court of Justice and received a decision in their favor, which was that what Kenya was doing was not in accordance with its treaty. Next slide, please. So 36A 13. So amend the first schedule to the Excise Duty Act by deleting the proviso to import glass bottles. So actually, I started describing this case before this slide. Maybe I had really enjoyed it in particular. But so for this product, the proposal is to reimpose a 35% duty on so Tanzanian manufacturer Kioo Limited, which I explained, they're not too happy about this particular one. So as for the previous slide, actually that particular section is covering so many other products from the East African community. So, and most of these products are used in packaging. So I mentioned earlier that the government talked about making it cheaper for exporters from Kenya to export to the world. Some of these exporters are exporting processed agricultural products. They need packaging. Some of this packaging might be coming from the East African community. So it's not clear in this case how that makes it cheaper for them. Next slide, please. Section 36B1, amending this third schedule. So in this case, removal of 5% preferential EAC withholding tax rate. So this removal will be replaced by what? A 15% preferential EAC withholding tax rate. So those pension funds, those private equity firms, those major financial investors who liked parking their money in Kenya will not be too happy, because now they have to pay a higher withholding tax rate. So we are helping, I mentioned at the top, helping some investors while hurting others. This is one group of the others that we would be hurting. Next slide, please. So in conclusion, sorry, actually previous slide, sorry, this actually belongs to my colleague, excuse me. In conclusion to this particular chapter of this presentation, what do we see? So the government is trying to prioritize Kenyan manufacturers over East African community trade obligations. So we're deleting exemptions for over 20 product categories and imposing new excise duties. Remember the definition of excise. Excise is about sin. It's a sin tax. It's a tax on stuff that you don't want people doing too much of anymore, because it causes harm either to people or to the environment. We don't see that this imposition of excise duties, first of all, it doesn't even match the definition, but it's a duty in any case. It's a tax, and it's going to hurt those who are exporting these products from the East African community to Kenya and not making East African community partners, like we said, very happy campers. So higher input costs, the results will be what? Higher input costs for Kenyan manufacturers that rely on EAC sourced materials. There's the risk of retaliation from East African community states, potentially harming Kenyan exports to those countries, those markets. The legal vulnerability. So we mentioned that in 2022, in the case of Kiol Limited, the East African Court of Justice actually made a ruling against the Kenyan government in favor of that firm, and so this could trigger fresh litigation. So also, Kenya raising export promotion incentives. Now, most of these were not actually in the finance bill, but were part of conversations outside of it. In the case of, say, agricultural exporters, where the cabinet secretary for agriculture had mentioned all kinds of support that that government was going to give to the agricultural sector. So you have that, but on the other side, packaging materials are going to be more costly, so it's contradictory. Next, the aggressive tax capture from foreign capital. So the bill's provision has provisions that attempt to claw back more economic value created within Kenyan borders, regardless of how transactions are structured offshore. So, for example, the government doesn't want you to escape taxation by structuring your exits abroad. So, for example, you built up Java, and now it's making a lot of money. It's everywhere with nice paintings when you walk in, and very nice coffee offerings. So it's making a lot of money, and you want to exit. And so you structure your exit outside. So you're selling it off. Maybe you've structured it, I don't know, in the UAE or something. And Kenya wants to make sure that with a 15% increase in a new structure designed to prevent these indirect share transfers this is a warning to firms that you can't avoid Kenyan taxes by structuring your exits abroad. And then through the removal of 5% EAC preferential withholding tax, raising that to 15%. This is a warning to to firms in the region that regional investment preferences are now over, and they must pay as other non-residents pay. This well, the risk again is that Kenya will no longer be over time, if this actually happens and persists, you could see the erosion of Kenya's position as a financial center for whoever thinks that that's important. That will, you see an erosion in that area. So that also includes what my colleague talked about, this attempt to increase the capture of royalties, things like you open up Netflix, they want to make Netflix more expensive for you.
Emmanuel,
yes. So
you
I'm
need to
getting the
conclude.
warning from my colleague to wrap up. So in essence, the winners might be domestic manufacturers, but we shall see. It's still a complicated picture, and those who have incentives within the Nairobi International Financial Center legal framework. The likely losers, EAC institutional investors, and EAC exporters to Kenya. Thank you.
I think the last slide, I think, yeah, so Raphael will wrap this, we'll summarize and conclude this for us.
So thank you, John. I think one of the things that John mentioned when he was starting the forum was that the targeted extra coin that the government is targeting in terms of raising this finance bill is around 120 billion shillings. But if you go across all the amendments that are contained in the bill, I think we come to a number of conclusions. One is that many of the proposed tax changes risk actually increasing the cost and discouraging investments. And if you look, quite a number of proposals. One, look at the income tax, you look at digital fees, royalties, capital gain tax, and indirect transfers, and even looking at some of the exemptions that has been provided. It tells you that it is a incentive in terms of bringing in investments. Number two is on the overall design of VAT, where it undermines the question of neutrality, but also question of also raising prices. And we are giving examples of shifting of the way the government normally come up with the issue of the first schedule and the second schedule, where we consider the issue of shifting from zero rating to shifting, and then from one exemption to 16%. Of course, some of those things, what happen is that it end up increasing the cost of production, and therefore, again, the consumer prices goes up, and this will lead to affection of some of the key sectors in the economy. On this one, we are talking about sectors like the health sector. You have got the social protection, which are key in terms of making sure that we have enough revenues. Number three is on the excise taxes, where Vivian has shared with us in terms of encouragement of informalities and illicit trades. And studies has been done by a number of institutions, including NTA in collaboration with Oxford, showing that the losses that comes because of illicit trade, counterfeits, issues to do with corruption, ranges from around 243 billion shillings to 253 billion shillings. And therefore, what we are saying is that we need to come up with a better policy so that we don't encourage illicit trade. Finally, is on there is a need to come up with a balanced approach. You need between revenue and then fairness, and also we need to have an economy that is growing. And therefore, we are saying that while some of the measures are clear in terms of integration and public health, others actually is actually creating a burden. And we are saying that there is need to have an overall policy which aims to have efficiency, equity, simplicity, and competitiveness. So thanks.
Thanks, Raphael, for that. And again, thank you to all our 6 speakers. Given that we don't have much time, I'm actually reluctant to provide any additional summary. So what I will do is first, obviously, to apologize for the disruption. I know we proposed that you moved from the current link to a different one, and it's because we had a technical hitch, and you agreed to that. But I can also see a few people fell off, so we apologize for that. So I guess we'll just go straight into plenary. So feel free to either raise your hand or unmute yourself. So far, I do not see any comments or questions in the chat. So we can have 2 rounds of plenary. So I see 2 hands. So we'll start. Yeah, Fiona, you can go first, then Kwame. Then we'll see whether there are any additional. More people would like to ask questions in this first round. Yeah, so Fiona, please go ahead.
Thanks, John. My question is mostly to Raphael. When he was making the presentation on VAT, one of the things that he mentioned in regard to credit for input tax against output tax, he argues that this is actually beneficial and should be retained because it improves VAT fairness and then it reinforces neutrality. But then towards the end of his presentation, when he's discussing specific sectors and products, such as cell phones and PPP infrastructure projects, he then argues that these items that have now been made VAT exempt, the 16% VAT should actually be reinstated. So I'm just struggling to understand how to reconcile these 2 positions, because on one hand, he seems to be supporting the VAT exemption framework and input tax adjustment for exempt supplies. But then on the other hand, he recommends reversing exemptions by reinstating VAT, especially for these 2 products. Yeah, thank you.
Yeah, thanks, Fiona, for that. I believe Raphael has noted your question. So yeah, so we'll go to I see another hand up. So Kwame, please.
Okay, so this is Kwame. Thanks for the set of presentations. One of the things I hoped that all of us together would have emphasized more keenly is the question of complexity of taxes. So that's the first, and whether Kenya's tax system is getting more complex. The second is there's an alacrity that I saw in the belief, some of us know, but not some of us, almost as if every tax that government collects is a good thing. I don't think that is true. And as students of economics, we ought to emphasize what the effects of taxes are, as taught to us in theory, and is probably proven. One, because of the deadweight losses. So we should think about what deadweight losses are being expanded. The third question, again, is a matter of principle. And in my view, in the application of excise taxes, we can give credit to government for, or rather, we considered at the beginning that there's a race, so to speak, for gaining as much revenues as is possible, but applying the basic principles about coherence of the entire tax system. And I think our first and second speakers emphasize that, not as much with the others. Especially, I think it should have come with us from the question of excise taxes. So, for instance, the fitness of a tax to purpose is as important as how much money is. And I think we re-emphasize too much the accounting mind about tax rates as all that matters. But for God's sake, I am still waiting to be persuaded about what is the logic or rationale for applying excise taxation, for which the policy objectives are known, the reducing externalities, and obviously internalizing externalities and reducing the size of markets for which harmful things are produced. So I think that would make us much more distinct. So I would have hoped that each of our speakers, if they have time, could actually comment on what they think is the coherence of not just this year's finance bill proposals, because Honorable Mbadi says that they're much smaller than that. That's true. In other years, they've been as much as 200. We have 52 clauses or 54 clauses this year. But what does this mean for coherence in taxes as a rule, and just generally of the tax policy in general? Because the territory that is being taxed is one. So if you have one tax, excise moving one way and income moving another way, what does that mean for the fitness of the entire tax system? And simplifying taxes would have been something that we could take as one of the proposals that we could sharpen this year's finance discussions on the finance bill. Thanks.
Yeah, so thanks, Kwame. So I believe our speakers have also noted your comments and the questions that you posed on just the issue of fitness of the tax system and complexity of the tax code, and the specific ones in regard to the issue of the debt losses, yeah. And of course, coherence of the entire system. So we go to the third one. Okay, maybe two more. So Joanne and then Benjamin can close this first round of questions so that I can allow our speakers to respond. So Joanne.
Yeah, thank you very much, John, and your team for having this webinar. I think it's something that you need to do more often, because we have a generation that's woke. I'll use the term woke since 2024. And, having such webinars is important. That said, Kwame removed what I wanted to ask from my mouth. Is there a way that we can make, this whole, it's called financial bill, less complex? And are there any jurisdictions that we can, benchmark with? Because we have young people, a generation that's, very concerned, and they want to understand how they are governed. Is there a way that we can have this whole tax regime simplified? Do we have a tax policy that can guide, the taxation process? Do we have to have, these taxation issues raised every year? What is it that we can do to simplify this whole financial bill for betterment of this country, considering that there's a lot of there's a lot of misinformation and disinformation that's going around right now, and creating a lot of animosity and raising a lot of emotions? Is there something better that Kenya can do? Thank you.
Thanks, Joanne, for that. And the final one I saw, was it Benjamin's hand? Final one for this round. We'll have another round.
Yes, thank you. Thank you to you all for the wonderful presentation. It was very educational. I had a question for all the speakers. The bill seems to have an administrative focus, but Kenya's tax to GDP ratio is relatively low, around 14 to 15%, and it has been despite multiple rounds of administrative reform. I'm wondering, is the compliance gap the actual constraint, or is the formal tax base too small to hit that 3.6 trillion Kenyan shillings, regardless of enforcement quality? Could it be structural changes to the economy, or what would genuinely expand the tax base rather than what this bill does, seemingly intensify its extraction from entities and people already inside it? Thank you very much.
Thanks, Benjamin, for that important question. So what I will do is, let's see. Yeah, so I'll ask our speakers. So there are some questions that are obviously specific to the speakers, and then some are general. Yeah, so we can start off in the same order. So Jackie, you can pick on any of the. I know there wasn't one. Was there anyone specific on an income? I don't think so. But yeah, so you can wait. You can respond to any of the questions that you think is maybe on the issue of the coherence in reference to income tax. Yeah.
Okay. For the questions.
And any other that you want to pick, and then we'll follow with the rest. Okay.
All right, that's fine. So the first question was on Fiona's question was to Raphael. So I'll begin with the question on complexity, whether Kenya's tax system is becoming more complex. And yes, I think there's that growing concern, at least on our side here, as the CLE program and as IEA, particularly from a compliance and even administrative or administration perspective. And to me, part of that complexity comes from the frequent amendments. If you listened to my presentation, I referred to specific amendments that we've seen over the last 3 years or so. So we've had revisions to various provisions annually, sometimes including even definitions, in what seems to us to be a bid to expand the base. So for instance, in the question of royalties that I spoke about on the amendments related to betting. So we see that lack of predictability in the structure, and that basically it is those principles that make our tax system more complex. So changing increasingly seeing layering of taxes, expanding some definitions, overlapping definitions. And so I think that is problematic in our view. And yes, I think our objective here should be to push for simplification and clarity and some sort of consistency, especially for proper compliance and easier compliance, and to even raise those, rather to even lower the costs that follow both for the taxpayers and for KRA. We need to, it should be easier if we lowered the cost for that. And then there was a question on the coherence of this year's finance bill in relation to the general tax policy. I think, as has been mentioned earlier, there has been annually a stronger attempt at either consolidating revenue mobilization around around different things. But from a coherence perspective, the concerns that we have raised is that some of the proposals appear to be reactive, just merely for raising or generating the revenue rather than being part of a stable long-term policy framework. So I've mentioned again, we've seen expanded definitions of a few things and this seemed to create a perception that the tax policy is evolving incrementally in response to different outcomes. A few of my colleagues mentioned their tax proposals being reactive and in response to litigation outcomes rather than to a comprehensive and predictable reform strategy. So that is what I would say, that there seems to be a broader tension between the finance bills and between Kenya's revenue mobilization strategy as listed or as structured in the finance policy. The tax policy. Then I don't know which, there was also a question on, so basically, how do we make this less complex? The question here, I think, to Joan's question on how to make the tax system less complex. So I think the first important step is obviously reducing the frequency of the substantive amendments or the very substantive changes that are made to core proposals, core tax definitions, and the core taxing or charging mechanisms. So those repeated amendments every financial year, particularly on the same concepts, are the ones that make the system difficult to follow and create uncertainty for the taxpayers. So reduce step one, the number of substantive changes that are made. And then our tax policy states that a number of principles underpin the way in which revenue should be generated, but we don't see full compliance to those principles. So I think Kenya should move towards a more principle-based tax reform rather than relying heavily on the annual piecemeal amendments. And then I think also clearer drafting. In my presentation, I mentioned a number of instances where the drafting is very broad and leaves room for a lot of possible litigation. So clearer drafting would necessarily be helpful to just simplifying the tax system. I think I can stop at that and then let my colleagues speak up. I'll come back later. Thanks.
Yeah, thanks, Jackie. Raphael, there's some that are specific. The VAT one from Fiona, and then any other that you can pick, either reinforcing something or whatever additional comment that you may have.
Yeah. Thanks, Fiona. And yes, I understand where you're coming from in terms of the reason why we would have a credit for input tax against output tax, moving from 16% to exemption, and then you have a PPP given by the government going on the opposite side. I think I have one. I think I have one reason for credit for input tax against tax. What that clause says is that it is an insertion of a new section where you are supposed to have an adjustment of making sure that input tax, when supplies become an exempt, I think Kenya Revenue Authorities will be able now to reclaim that, and therefore this will be a follow-up from Kenya Revenue Authority. And therefore, what we are saying is that from the farm perspective, given that farms principally they usually make profits, is that it will improve fairness from the side of government in terms of making sure that when you do a deduction, because we know what farms sometimes does, you are deducting from an actual use of that particular service or a product that you are claiming an input tax. And therefore, what it means is that you'll be able now to reinforce the aspect of neutrality of the VAT neutrality. So that perspective must be very clear, that we are talking from the farm perspective when you're talking about claiming credit for input tax against output tax. When you're talking about PPP, and then making sure that when you are moving them from 0% to exemption, what we are saying is that we are making sure that the government is able to improve economic impact on the project and making sure that the operations of that particular project is on the lower side. And therefore, this is something This is something that can be able to can improve the aspect of public-private partnership on project. The other aspect, and this is something, Fiona, we can have a deeper discussion on that aspect of making sure that there is no collision between the issue of credit for input tax and the issues of PPP in terms of exemptions. The other aspect that I need to mention is the question Benjamin has asked. Benjamin is asking about the question of compliance. And one of the key aspects, and he mentions that if you look in terms of administration of in terms of how much the government is able to correct in terms of revenue, it ranges between, and you say from 14 to 15%. And you raise the question of the compliance. Yes, and I do agree with you in terms of the leakages that we have in terms of compliance by the Kenya Revenue Authority, starting from the e-systems and making sure that revenues are corrected at source. And you can give examples of even the local government where we have issues of and we need to say these issues of corruption in terms of correcting our levies. So in terms of making sure that our revenues are corrected and we increase in terms of percentages as to GDP, then we must make sure that we make sure that we do not have to we make sure that the issue of compliance by the Kenya Revenue Authority is improved so that we can be able to improve our revenue collection relative to the GDP. The question, Kwame, is I don't have much to say about the complexity of taxes in the Kenya system. And Kwame is very clear on that he does not understand why we should be able to include an excise tax on something like airtime. And we know the purpose of an excise tax. I agree with you entirely in that the principles or the canons of taxation states very clearly that our tax system should be very simple so that a citizen is able to interpret, understand when taxes are due, and our Kenya tax systems keep on changing. And I have to say that sometimes I don't even understand why we keep on changing our tax system through finance bill year by year. And I'll give an example whereby the question of shifting from zero rating to exemption, or even from zero rating to 16%, where it actually pushes away investors from the country, and therefore the question of competitiveness coming. Therefore, this is something that we need to have a candid discussion by the national treasury, where a review actually should be done, where a review of tax components should be done for at least 3 years, and to make the environment conducive environment for making sure that we have a proper investment in the country. Thanks.
Okay, thanks, Raphael. Vivian, any? Of course, there's that question on excise duty, and whichever other question you'd like to take up.
Okay, thank you. Since most of the questions have been addressed, what I'll just comment on, I'll agree with Kwame by saying that not all taxes are good, and not all forms of taxation apply everywhere, especially for excise tax. There are some instances that it is not applicable, especially we saw when it comes to mobile phones and even airtime and all that, because it is only applicable where a specific good leads to negative externality and also it is harmful. So taxes are not good in that they reduce disposable income of households. So and also taxes should also be clear enough. And concerning the question of complexity, I think my colleague Jacqueline and also Raphael have talked about it. So I'll agree that not all taxes are good, and excise tax should not be applicable to other products. Some products which do not have negative externality and are not harmful to the economy. Yeah.
Yeah, thanks, Vivian. Very quickly now to either, Steve.
Yeah.
Yeah, anything else that I know most of the questions have been answered.
Yeah, actually, Vanessa, just to add maybe one thing to the question Kwame was asking is to mention that, of course, and Jackie has spoke to it as well as Raphael, the issue of complexity of tax system, I think there's need to rein in on that and ensure that we adhere to international best practices in that way. And also to Joan's question, I think that is a challenge to us as IEA. We could go ahead and do other similar presentations, perhaps on other platforms like on X, and maybe just do some snippets on other, maybe TikTok or Instagram, and see how that appeals to the work community. Thanks.
Yeah, thanks, Steve. Jairus?
Thanks, John. To respond to the issue that was raised by John, finance bills every year more complex. Can we do that? Can we do away with that? I think yes. And she also asked if we have some policy that guides us on taxation. I think our argument as IEA has been that we actually don't need to do finance bill every year. And that is very possible. And then on the issue of the policy, actually we have one. It's called the National Tax Policy of 2023. That's session on paper number two of 2023. But it's sad that it's a document that our parliamentarians don't have on their desks when they're discussing finance bill, because if they did, then we would have some predictability where we don't have to change some tax laws every day. I think it's also possible if you can do medium-term plans, then it's very possible to align budgets within that 5-year cycle, or like 5-year cycle, and align that, say, this will be our ceilings in these 5 years, and that will also apply to taxation. And I think that therefore will remove the need to have, of course, we will not have supplementary budgets except for emergencies. So when these two are aligned, then I think we will not need to have these annual revisions in our tax laws. Benjamin brought the issue of our low tax rates for to GDP, and that's around 14 to 15, and the issue of compliance gaps, I think, which Raphael has handled. But I think for Kenya's economy, 14 to 15 is not low. It's not a small ratio, considering low incomes. I think we are doing just slightly above 20,000. That's about 20,000 Kenya shillings in average incomes, and the poverty rate in the country is 40%. That also should tell you something about our the size of the population that actually contributes to income tax, because we have a small formal economy, and that means even that 14-15 is by other standards is just a high ratio. And I think raising those tax rates will not be able to cover that, because it will increase the burden to, for example, those on payroll taxes. And our experience of 2004, that's June 2024, also shows that there's a limit to how much of the tax burden people are willing to take. And I think the best solution there would be to expand the tax base, which of course government is trying to do that through different measures. The IEA has proposed some have been taken up, there's some reluctance. For example, there's been a recommendation to lower some tax rates and expand the application. That would include maybe VAT, but not on basic goods, which will increase the burden on lower income households. And recently we have some other groups that are advocating for lower the income tax rates. That's pay as you earn. Yeah, so I think that and the main argument is that when these people will have more disposable income, and also so that will have effect on economic growth. That is on consumption and on other economic activities. Going to Kwame, which will be my last comment on coherence. I'm looking at this Miscellaneous Fees and Levies Act, which has several levies. So number one, you find that like for the export levy, we have 50 tariffs. That's 50 tariffs, and 20 of them have different tax rates, which just makes it even more complex. And then remember, we do these revisions regularly, which complicates it further. So I think that is one thing that we'll continue to put our weight on. And then biggest problem and why we recommended that this should be done away with is that, and agreeing with Kwame, is that we are applying some taxes where we don't need to. We are applying a tax levy on goods as high as 50% according to the current rates. And at the same time, those goods maybe could be going to countries where we have the imposition of tariffs on them. So you've already discouraged export on your end, or you've made your exports expensive. And then on the other side, we have tariffs. And so your competitiveness in those foreign markets is just completely wiped out. Yes, I think that will be my contribution to responding to the questions. Thank you.
Yeah, Emmanuel, I know coming at the end here.
Yeah, thanks.
If you have anything that you'd like to add.
Yeah. So, Steve, can you? So, if taxes have income effects, substitution effects, as they rise, as taxes, which is to say that there's a response to those taxes. First of all, your income shrinks, right? Whether you're a consumer or a producer, because now people are consuming less, etc. And then you have the problem that taxes destroy efficiency. And so that's that dead weight loss that we talked about. And you basically are eating away at surplus for both consumers and producers, which is the welfare. So what you want to see is a commensurate provision of public goods in that sort of covers or maybe exceeds the value of the losses incurred. But in Kenya's case, and then in addition to that, what you want to see from the design of the tax regime is that it's simple, it targets a broad base, and that it's slow, and then it remains stable over a long period of time. Why all these things? Because if a tax regime is not simple, if it's complex, then you incur more costs in just complying, right? Your compliance costs rise. If it's very high, we've talked about the effects that has on your efficiency. If it is narrow, then that means it's targeting a very small share of the population, right? A small share of the productive sectors of the country. Then again, that burden is destroying efficiency in that area. And then if it's unstable, then it's unpredictable. In Kenya's case, Kenya's tax regime is actually the opposite of all those attributes, which means it's bad. And then not only that, you can see the tax burden on the population is very high. Now, we might ask, why might that be? Surely there's at least one or two good people in the government, and one could argue maybe there's many more. For one thing, you have a government that keeps on growing, will keep on growing, because I don't want to lose my job if I work in the public sector. So they better keep those taxes up. And then you have all those what happens with constituencies, and the government has its own constituency. So the call to the public is, like our friend who came in and said, she wants to see more of this. You could also put that question on its head and say people should actually be rushing to look for these kind of presentations to try and understand the problem, because ultimately, perhaps the reason they're not is that failure to understand that the government function is determined by many things, including and most importantly the magnitude and sophistication of how the public actually interfaces with the government processes, how it is they who are supposed to hold the government accountable, and they should assume that hey, if I don't hold the government accountable, if I don't watch what they're doing, then they're going to do things to their own benefit, as I would if I was in any position. Just a baseline without getting into any kind of to balance that other extreme whereby we want a government to just do the right thing because it's the right thing, and we can't understand why, and so you want to demonize them and say, okay, maybe not, just build up the pressure. Thank you.
So again, thanks to our speakers. You've all weighed in to some degree on each of the questions. I have two additional comments to make or responses, particularly in regard to the last question that was asked by Benjamin. So the first is, of course, when you juxtapose the finance bill to both the medium-term revenue strategy and national tax policy, and of course the objectives therein from those two documents, obviously what the documents speak to is the question of predictability, certainty in the tax regime. And what the national tax policy talks about is that the expectation is that amendments or changes to tax is not expected every year. Of course, that also ends up increasing the complexity of the tax code. So of course there are schools of thought that after all, what is the fuss about these annual tax policy changes every year if what is expected to be raised is actually for 2026 it's about 4%. As I mentioned in the beginning, for the previous years it has ranged between 8 to 10, whereas obviously that's substantial. But again, when you weigh it against these changes and the impact of the changes, then maybe there's no need for all this, for changing the tax code every year. And then secondly, yes, Benjamin, you're correct. Obviously, in trying to understand our tax to GDP, the fact that it's about 14 to 15%, Yeah, so actually when you conduct what is called a buoyancy test, which speaks to the issue of the responsiveness of tax to change in our income or GDP. Our tax system is actually not buoyant. It doesn't respond to those whatever the changes in income, because for every 1% change, the revenue that is collected is about 0.8. So obviously, what explains that is the structure of the economy, large informal sector, as Jairo has mentioned. So basically, what I'm trying to say is that it means then the interventions should not only be in terms of tax reforms, but there are other things that are important that would go a long way to enhance domestic resource mobilization. And actually even related to the question of compliance. For compliance, empirically, when citizens see that services are delivered, there's proper use of taxpayers' money, then that enhances compliance. Obviously combined with other things like education, tax education, and so on. So basically what I'm also talking about is the question of governance and political stability. Those things are critical in terms of enhancing compliance. And then for buoyancy, no doubt, the question of if you look at the structure of the economy, agriculture contributes, the agricultural sector contributes about 25%, a quarter to GDP. So enhancing that through complexity and so on, labor intensive, value addition, labor intensive, or policies, reforms towards enhancing our manufacturing sector are critical in terms of contributing to revenue. So I think those are the other aspects that that the government needs to focus in regard to the question of enhancing revenue collection. Yeah, so thanks. So we have the final round, and I know time is long gone, and we have. So I don't know whether there's any one burning. Maybe I will just give an opportunity to any one burning question. So if not, I will ask my colleagues to quickly prepare to just give their final remarks. Not more than please don't take a minute. Yeah, again, we'll start with the same order from Jackie all the way to Emmanuel. If you indeed have any final remarks, yeah, because I don't see any other question, so that we can bring this to a close.
All right. Thanks, John, and thanks everyone for your questions. So for me, I think the main takeaway from our analysis today was that, we've seen that there may be legitimate revenue mobilization objectives, but the amendments and our overall tax policy must also remain predictable and coherent and supportive of economic growth. So our recommendations are for Parliament to adopt a balanced approach in order to preserve the policy stability. So basically that's what I'd say, and happy to share the greater expanded analysis after this session. Thanks.
So for me, I think I have two things I need to mention. One is that we need to have the government need to make sure that we avoid exemptions that distorts market. And then number two, we should be able to support the issues of compliance, because once we do that, then even in terms of economic growth, the economy will be able to grow, and then out of growth, then the government should be able to generate the required revenues for spending. Thanks.
For me, my final comment, just Parliament should take its work seriously and interrogate this finance bill and expand the parts that needs to expand, and the ones that are good for the economy should be taken up. Thank you.
State our recommendations, that is, do away with the export levy and encourage expansion of production for export markets. That's for Kenyan goods, and that will achieve those desirable goals of government, including creating jobs. Do away with that export and investment promotion levy. Let the goods, imported goods, be affordable. And already, of course, these are just additional taxes because some other taxes have already been levied on those goods. So we recommend that the overtaxation behavior ceases. The same applies to import declaration fee, which we found that it's 8 times higher than Tanzania's and 3 times higher than Uganda's, and just makes Kenya so different from even our neighbors. And to get more revenues, which we said, don't touch tax rates, don't raise tax rates, but just stimulate growth. That is promoting policies that stimulate growth and actually overtaxation, as we see some of the measures in this finance bill just achieves the opposite of that. That's it from me. Thank you.
My comment is thank you for attending. I think it's important for the public to really conceptualize their relationship with the state as employer-employee, the citizen being the employer, and that it's incumbent upon them to actually take up the what issues they have with the finance bill in particular and public affairs in general, and that if we are to see an overall trend towards a simple tax regime that is broad, has low taxes, that implies that the government actually becomes smaller, that will take a lot of focus and discipline, and most importantly, a lot of external pressure coming from the public if that's the direction that they would like to go. And so here we have the information and the analysis that sort of gives you a taste of what where things are and where we think things should go. Well, it's up to us all together. There is no real magic to it. Thank you.
Thank you a lot for your contributions and the discussions that we've had. So thank you. You can use the React or whatever it is here to just help me appreciate them. So as we close, the presentation has been posted. So we have a link in the chat board, and the memorandum that the IE has put together will also post that on our website. So please look out for it. And just to mention, of course, today the focus was on the finance bill, understanding of the finance bill, basically what it means, its implication, and so on. We have another webinar that will be coming up soon. Actually, the idea was, the intention was to have it. We weren't aware of this holiday, so we were to have this webinar yesterday, and then follow it up with the one that I'm referring to today. But we'll communicate those dates. So please look out. Look out on our website and social media platforms. So that webinar will focus on the expenditure side, just basically the budget. So we have what we are calling an alternative fiscal budget. So we'll have a conversation and discussion around that soon. We'll mention the date because we were thinking of having it tomorrow, but we'll communicate that. So please look out for that. IEA is actually not only a think tank, but also a membership organization. So if you'd like to be a member, and membership is actually open for everyone, whether you're a student, whatever professional. So feel free to get in touch with our communications team, or just basically visit our website. We have details on details about membership there. So thanks a lot again. If you have any additional questions, feel free to share those. Of course, there are certain things that we have not discussed. As I mentioned in the beginning, the finance bill is quite big. So the focus was just basically on highlights. So the additional info on that you'll find in the memorandum that you will post after this. So you can interact with it just for additional info.